Hey, welcome back to International Wealth Builders Radio Talk Show. This is Michelle Estelle. I am your host. I am the homebuyer coach. And today we are talking about loan level price adjustments. So we've already spent some time explaining what they are, explaining a little bit about the grid and the heat map that showed which loan level price adjustments were going to increase and which were going to decrease, which started all the talk about poor credit buyers getting a better rate than good credit buyers. So that's what I want to delve into right now, that particular part. Some people were saying that if you harm your credit, run up your credit cards, lower your credit score, that you're going to get a better mortgage rate. Well, that is not true. Because although a low credit score, low down payment borrower got the benefit of these changes, and a better credit score, better down payment borrower does end up paying more, it's still not more than the lower credit score, lower down payment borrower. They still do pay the most. They just got the best improvement on the grid. And then, as I mentioned, your very high score borrowers with your very large down payment had little adjustment. So the biggest adjustment was in that middle sector. An average score, 680 to 720 is going to pay more than they used to, and a lower credit score borrower is going to pay less. So in effect, subsidizing low credit score buyers by charging someone else. So that part is true. However, harming your credit is going to make you pay more, because a low credit score still pays more than a higher credit score. So you can't get a better rate by having worse credit. So I just wanted to clear that up. The other thing is that people were mentioning the down payment, and even I've heard people in the industry saying that when you put more down, you have a higher rate, and they said that was new, but that's not new. If you put 15% down, you have a better rate than if you put 20% down. So that seems a little off and, counterproductive, but the reason why that scale tips when you get to 20% down is because at 20% down, there's no mortgage insurance. So if you remember in segment 1, I was talking about the fact that if a lender has to take back the mortgage and they have to sell your house after foreclosure proceedings, it costs them about $30,000 to sell the house on average. Probably sometimes more, sometimes less, but it costs them that much to just sell the property outright. So right off the bat, they can sell it to satisfy the debt. But if the debt and the sales price are the same, they're going to lose $30,000. Either way, they're going to pay about $30,000 out of pocket. So that's going to minimize any proceeds that they get in order to satisfy the debt. So because it has no insurance, there's nothing to cover those costs. And that is why when you go from anything less than 20% down to 20% down, the rate is slightly higher. So that is true, but pretty much for a very long time has always been true. And the reason is no mortgage insurance at 20% down. So you cannot get a better rate by getting a worse credit score. That myth was wrong, and I'm just reiterating that. Down payment does help. Significant down payment obviously reduces the loan level price adjustment for loan to value. The last piece, I think, is the most significant, and very little conversation was had in the social media world, influencer world, political world about the fact that there's one more component to the advantage, and that is if you have low income. If you have a low credit score or moderate credit score, but let's focus on the low end, that grid, bottom sector of the grid, if in addition to having a low credit score and a low down payment, which you're considered high risk, in addition to that, if you are in the low income, could be considered moderate income, it's 100% AMI. If you are at that income bracket, you have zero loan level price adjustments. So the biggest benefit to anyone is in the low income rate. That's where the person gets the best rate. And definitely, I would say the way that the scales tilt, which I have not actually compared, but if you look at no loan level price adjustments at all, knowing that the loan level price adjustments went up for the borrower that had the 680 or better score, if they have low income, they are going to get their loan level price adjustments waived as well. So let's say they do have good credit and they happen to have a good down payment, so they're already better off. But if they also have low income, they also will get a much better rate. But the person with the low down payment and the low credit score and low income, that's the targeted audience that's getting the best rate of all. They are going to get the lowest possible rate of all of the rates. So the moderate income buyer, the middle sector with the good credit score and even a low down payment to moderate down payment, they're also going to have an advantage if they have low income. So anyone with low income is the winner in the new loan level price adjustments. That is for certain. And I'm not sure why that wasn't given the attention, because that's the biggest news of all, is that anyone else is going to subsidize for the low income borrower. Everyone, even the 620 credit score borrower that still has to pay a higher loan level price adjustment, just not as high as they did before. If for any reason they're not at the low income bracket, but they didn't have a higher down payment and they had a low credit score, they're paying for everyone too with a low income. So 0 loan level price adjustments if you have low income. If you are at 100% AMI or less, you're going to get the best rate on the grid. Now remember, once again, that doesn't even mean that you can get a loan approval, because if you do have a low score and you do have a loan down payment and you do have a low income, even though the income is only going to be relative to the amount that you qualify for monthly payment, so all things equal, the payment that you qualify for is the payment you qualify for, but the opportunity to have the lowest possible rate with no loan level price adjustments will still mean that you need to get an AUS approval. And it seems that it's very tough to get a loan approval like that if you don't have substantial credit. And with a 620 score, it's probably a given that you don't have substantial credit score. However, somebody with a really good credit score with just one 30-day late recent can drop their score a bit. So there's 1,000 different scenarios that we can talk about between all of these risks, which is down payment, credit score, debt ratio, property, basically. We could put together thousands of scenarios at different scores, different down payment, different income bracket, different types of properties, and some people can get approved and some people can't, which is the other part of all of the scenario, is there is no one size fits all. And that's what I said in the first segment. When you call and ask me what are the interest rates, there are no interest rates. There is a bunch of opportunities for interest that you can get, mostly based on your specific situation, credit score, down payment, debt ratio, the program that works best for you, the property that you're buying, and all those things are going to determine what that score would be. There's also an inversely proportionate scale of interest rate. So if you said, well, I really want the rates to be 5, there is a 5% on that sheet. It's just that it comes with a cost, and those are similar to loan level price adjustments. Those are discount points. So everything starts at a base rate, and then the LLPAs are added to it, whichever apply to you. And then if you have low income, they're all taken away. So you have 0 ads, but you still have the cost for that rate, the base rate, without the LLPAs. So if you wanted to get 5% on a rate sheet with no LLPAs, maybe you could get that for paying a few extra points. You can get a really low rate. That would be a permanent buy down. You also can do temporary buy downs. So those buy downs that are temporary are payment buy downs. They are not rate buy downs, because the rate remains the same on the note. You just get a subsidized payment for a period of time. And that's like paying that additional part up front by somebody in the transactions. For instance, the seller or the lender putting the money up to subsidize the payment for a temporary amount of time. But there's a lot of rates on that rate sheet. And I would say, if it goes about 8 or 9 deep, that if you had enough money and if the numbers work out for the California high cost and you can pay enough points, there's a possibility to get a lower rate than you would think, a lower rate than maybe advertised by buying that rate down. But we always start at the base rate and then we add all of the loan level price adjustments on top. And the number one thing for this segment is if you have low income, no loan level price adjustments. So winner, winner, chicken dinner for the low income person gets the best rate. So next segment, we're going to wrap all this up and I'll be back soon.